Okay, good afternoon and welcome back, everyone. I hope everyone is having a great day. Today, we're here to talk about three top strategies to generate income using weekly options with options. So today, we want to cover this topic, because for everyone that's out there, we're all different traders. We have different portfolio sizes, we have different holdings in our portfolio, yet options provide a lot of opportunities for us to generate income. Now, depending on the type of portfolio you have and the type of holdings you have, different strategies make sense. So today what I want to do is I want to cover three strategies that will allow you to generate income for effectively any stage of your portfolio, because different strategies allow you to do this, and whether you own certain stocks or you want to purchase some stocks, or perhaps you just simply have a directional view on a particular stock, there are different strategies using options that allow you to generate income using weekly options. And I want to talk a little bit about why weekly options are specifically geared to help these types of strategies. So today we're going to talk about basics, meaning we're not going to get too in-depth into each specific strategy. However, if you want to learn more about each one of the strategies that we'll talk about here today, we do have previously recorded webinars, so I highly recommend you to take a look at those if you do want to learn more about either one of these strategies in depth. Today we'll talk about best practices for each one, a brief overview of each one to give you a sense for what the strategy is, when to use it, what are best practices, and then if you want to learn more, we'll point you towards the webinar recordings that will allow you to learn more about each individual strategy. Now, one of the things I do want to address that is in addition to what we typically do is I want to address the question of options liquidity, because I get a lot of questions from users about open interest, about options sometimes that have large bid-ask prices, and whether or not it's suitable to trade those specific options. So I want to take a look at a few examples of stocks that are in the S&P 500, which we typically think of those stocks as very liquid. I want to take a look at some of those stocks. I want to look at the bid-ask spreads. I want to look at the open interest, and I want to show you where trades actually get executed to provide some, or shed some light as to, when you see these types of scenarios, whether or not it's a strategy that you should think about deploying for your portfolio. So my name is Tony Zhang. I'm the Chief Strategist here at Options Play. I will walk you through everything here today. The webinar is recorded for those of you that are brand new. Not only do you get the webinar recording about half an hour after we finish here this afternoon, we'll also send you the slides so that you can follow along. And there's some important links in the slides for those of you that are brand new. So if you've never seen Options Play before, welcome. You can sign up for a free 30-day trial to Options Play using this link, which I will now send in the chat window. Membership for our tool is only $50 a month or $500 a year. And if you sign up today, you get a free 12-step options trading course to help you get jump started on your options education, including daily options trading ideas. Now, for those of you that already have a subscription or already on a free trial, you can still also input your email address and name into that link to get access to that free course if you'd like to. So with that, let's go ahead and get started. Today, what I want to do is I want to cover the top 3 income strategies for any portfolio. Doesn't matter whether you're brand new to options trading or you're an experienced options trader. I want to talk about what those 3 strategies are, and then we'll talk about how to go about selecting the appropriate expiration and strike price for each one. The great thing about any income strategy is that the expiration selection piece of it is pretty much consistent across all income strategies. The strike selection piece does vary a bit depending on the strategy, so I want to dive into the strike selection of each individual one. Once you understand the best practice for each one, then we'll talk a little bit about how to generate consistent income, meaning how do you generate a stream of income in your portfolio using one of these 3 strategies, or a variety of these 3 strategies combined with each other. And lastly, we'll talk a little bit about exit strategies, or how to manage these trades, before we jump over to Options Play and show you some real examples. Like I said, we do have, in addition to today's webinar, because I wanted to address the concept of liquidity, and I want to make sure everyone understands how to go about analyzing a specific option series and whether or not there's enough liquidity for you to trade that. So the top 3 strategies that we'll cover is selling covered calls, selling cash secured puts, and lastly, selling credit spreads. Now, these 3 strategies represent probably at least 70% of the option selling strategies that most retail traders will trade, and of which the bulk of which is going to be in cover calls. So the reason I cover these 3 strategies is because these 3 strategies allow you to generate income regardless of what your portfolio looks like today. Meaning, if you own some stocks, you want to sell cover calls. If you want to own some stocks or you're thinking about purchasing some stocks, cash secured puts allow you to generate income while purchasing those stocks. And lastly, if you have no interest in touching any stocks, but you simply just want to speculate on some direction, credit spreads allow you to do that. And some of you may have multiple scenarios where you already own some stocks, but you also want to pick up some stocks and you want to do some speculation. So for those of you that fall into that camp, you can utilize all 3. So the goal here today is so that you have an understanding of the different strategies so that regardless of what scenario you're in, you can find some strategy that's suitable for you to potentially generate some income. So the first one we'll cover is selling cover calls. Now, many of you that currently have an options agreement with your broker or have traded some options already, you're probably familiar with this strategy the most. This is a strategy that allows you to add yield to an existing portfolio of stocks. So if you already own stocks in your portfolio and they're sitting there, whether they're dividend paying stocks or non-dividend paying stocks, this is a way to increase the income on your portfolio by selling calls against the assets that you already own in your account, and those assets being stocks that you own. And this strategy lowers the portfolio volatility and the cost basis of the stocks that you own while adding this income stream to your stock holdings. Now, if you're thinking about buying some stocks, meaning there's some stocks that you like, maybe you're thinking about placing a limit order to purchase these stocks, then you should consider selling a short put or a cash secured put, as some of you know this as. This is really a strategy for stocks that you want to own, and this is really an alternative to purchasing the stock with a limit order. And these 2 strategies really should be used hand in hand. For any equity investor, you should really think about selling cash secured puts to get into the trades, into the equity positions that you want to own. Once you are in those equity positions, that's when you should consider selling cover calls. Most people think of cover calls as the first strategy they trade, but in my opinion, as an equity investor, you should be thinking about how do I generate yield as I purchase the stocks that I want to purchase, and then cover calls are a strategy to implement once I've acquired those individual stocks. So if you're just a stock investor and you have no interest in speculating, you just want to be a long-term investor in stocks, then you want to focus your attention on just selling cash secured puts and selling covered calls. Now, for those of you that do like to speculate on individual names, whether it's trading stocks or ETFs, where you have a bullish or bearish view on an underlying stock, that's where selling credit spreads are useful, because this is a strategy that's actually quite forgiving. You tend to have fairly higher probability of profits with these types of strategies, and it's an income strategy for stocks where you have a bullish, bearish, or even a neutral outlook on that individual stock. You can sell put credit spreads and call credit spreads that allow you to take a neutral or mildly small directional view on any underlying stock or ETF. So those are the 3 strategies that, regardless of what scenario you find yourself in, you can utilize options to generate some income on your portfolio. So what I want to do today is I want to explore each one of these strategies a little bit more in detail. Like I said, this is not meant to be an in-depth explanation of each strategy. We do have whole webinars just on each one of these. So if you want to learn more, I highly recommend you to take a look at our YouTube channel, which I'll send a link at the end of our webinar to show you guys how to access these previously recorded webinars. Now, with any of these 3 strategies, we are going to be selling options, whether for selling covered calls, selling cash secured puts, or selling credit spreads. We're always going to be selling options. So it's really important to understand how an option price is affected by time because that helps us understand why it makes more sense when we're selling options to focus on the shorter end of the spectrum, meaning the weekly options versus longer dated options like 2-month options, 3-month options, or even longer dated options. So what I have here is a time decay curve. What this shows you is that if everything else is constant, how the value of the option will decay as you get closer and closer to expiration, because there's less and less time for the stock to make its move. And as you approach expiration, the time value of an option erodes to zero. And that erosion is actually what works in your favor when you're short an option or when you sell an option. When you sell an option, you want that option price to decrease in value. And notice that the speed at which that option decays, or the speed at which the option decreases in value, actually accelerates as you get closer and closer to expiration. Most of the time, you will actually see the same amount of acceleration in the last month or so as you do in the previous 2 to 3 months. What that means is that if you sell a 3-month option for $2, you're going to collect about $1 of income in that first 2 months and collect another $1 in that last month. So you obviously want to collect $1 in a month rather than over a 2-month period. So which is why whenever you're selling any form of options, doesn't matter whether you're selling covered calls, cash secured puts, or credit spreads, or even for those of you that are a bit more advanced and selling iron condors, butterflies, strangles, any type of option selling strategy, you always want to lean more towards the shorter end of the spectrum because of this time decay curve. Now, this doesn't mean that you have to trade weekly options. This just simply means that if you're thinking about selling options and you're choosing between 2 different expirations, you want to focus more so on the shorter dated option because you will get that time decay much faster. So let's go ahead and move on, because I want to spend a little bit of time talking about strikes. So once you've determined your expiration and strike price, how do you actually generate consistent income from any of these strategies? And the answer is actually quite simple. It's actually choosing a consistent expiration date and strike price based on best practices and using the same methodical approach each cycle. And automation really facilitates this consistency. So what I want to explore in the next couple of slides is what are the best practices for selecting strike prices. Now that we've already discussed that with any option strategy, you want to focus on shorter dated options, namely mostly the weekly options. But then when it comes to strike prices, it depends on each strategy. So let's go ahead and explore the best practices for strike prices. So again, we have 3 strategies: cover call, cash secured, credit spreads. So when we're selling cover calls, this is again for strategies, this is for when you own the stock and you want to generate some income on those assets that you hold. So selling cover calls is a strategy for when you have a bearish or neutral view on the stock that you own in your account. And the goal here is to simply sell, again, shorter dated options, so less than 1 month out. And you want to sell call strike prices that are above the current price. So if you have a stock that's trading at $100, you always want to sell a cover call that's above the current price, a 110 or 115 call. That's the type of strike prices that you want to choose. And I'll go a little in depth in the next few slides as to a little bit more accurately how to choose strike prices. But when you're selling cover calls, you always want to sell a strike price that's above the current price. Because the best way to think about this is think about if you own a stock and you're going to you want to take profit on that stock. Where do you place that limit order to take profit? Because selling a cover call is similar to placing a limit order at a higher price to sell your stock at a profit. So if you own a stock at $100 and you think it's going to rise to 115, normally you place that limit order to sell your stock at 115. Now what you're doing is you're just selling a cover call at that same price, and instead of placing a limit order that doesn't pay you anything, a cover call generates yield, which also allows you to sell your stock at that strike price. And that's really why you want to utilize cover calls as a way to exit your stocks, as opposed to placing a limit order, because it generates an income stream on those stocks while you wait for that stock to appreciate and allow you to take profit on that stock. Next, on the cash secured puts, this is for stocks that you want to own, where you have a bullish to neutral view on that stock. And and to start off, when you're selling cash secured puts, also selling less than 1 month weekly options. And for puts, you want to sell them below the current price. You want to sell strikes below the current price. So if you have a $100 stock, maybe you want to purchase the stock at $95. Traditionally, what you do is you place a limit order to buy that stock at that $95 price. The problem in placing a limit order is that it doesn't pay you anything. So that's why selling a cash secured put, you sell that same 95 strike, it allows you to generate an income stream while you wait for that stock to dip in order to purchase your stock at a lower price. And this allows you to dollar cost average into your stocks at a discount, because the income that you receive by selling puts will also go towards the payment for purchasing that stock. So if you're able to sell a put for $1, now you're able to purchase your stock at a $1 discount. Imagine if you're able to purchase every single stock you purchase with a couple of dollars, with a couple of percentage points of a discount. What does that do for your bottom line? This is really where using these types of strategies in a methodical approach allows you to not only purchase your stocks at a discount, but once you're in those stocks, generate additional yield, which goes to enhance your overall equity position as a whole. And lastly, selling credit spreads. This is, again, a very forgiving strategy. This allows you to sell a credit spread in pretty much any environment. It doesn't matter whether you're bullish, bearish, or neutral. There are different credit spreads that you can sell. Now, you can sell put credit spreads when you're bullish, and you can sell call credit spreads when you're bearish. And I cover this in much more detail in our credit spreads webinar. So if you want to learn more about credit spreads, I highly recommend you to take a look at that. But when you're selling credit spreads, same thing. You want to sell relatively short dated options, less than 1 month out, typically the weekly options. And you want to always sell an at the money strike while buying an out of the money strike to limit your risk, because selling that at the money strike is really what's allowing you to take this mildly bullish or mildly bearish view. But when you're just selling an at the money call or put, you have unlimited risk. So the reason that we buy back out of the money call or put is to really limit your risk so that you don't have unlimited risk when you're doing these types of strategies. And this is a strategy that has very high probability of profit, and it's really useful for neutral directional outlooks as well, because if you feel that a stock that's trading at $100 is not going to move very much, if you're an equities trader, there's nothing you can really do. You can't make money on a stock that doesn't move. When you're selling credit spreads, you can actually make money from a stock not moving anywhere. So this is really the benefit of utilizing option strategies to generate income that you simply don't have when you're trading just stocks. So those are the 3 strategies that you could utilize. Like I said, this is just a brief overview of each one. If you want to learn more, take a look at our webinars on those specific strategies. So I want to talk a little bit more about why, when we're selling these types of option strategies, you want to focus our time on more of the shorter end of the spectrum. But I will say, based on your personal preferences or how frequently you trade, that is typically how users dictate which type of options they sell. So active traders will usually sell shorter dated options, 21 to 49 days out. Casual investors, 50 to 90 days out, and buy and hold investors that are trading really long-term strategies will typically trade much longer time frames. So this allows you to select the time frames based on your preferences. Now, based on our research, it's very clear that when you're selling any type of option strategies, you want to focus more of your time on the shorter end of the spectrum. And this is for 2 primary reasons. Number 1, you want to sell covered calls, sell any of these strategies. You want to avoid selling them during earnings for the most part. I will say that on certain strategies, selling credit spreads, you can use those during earnings because you are trying to speculate on direction. But when you're selling covered calls, when you're selling cash secured puts, you generally want to avoid selling earnings. Now, when you're selling shorter dated options, so if you sell a 1 month call, you can do those 12 times a year. And we know that there's 4 earning cycles every single year. So how do you actually go about utilizing these strategies to avoid earnings? Because when you sell short dated options, you can avoid the 4 out of the 12 times that you sell earnings and be able to avoid selling earnings 25% of the time. But if you sell long dated calls, if you sell 3 month calls, then you could only do those 4 times a year, which means that you really can't avoid selling during earnings. So this is one of the reasons why we want to focus our attention more so on the short end of the spectrum rather than longer dated options. And second of all, premium that you receive by selling a call, put, or credit spread is not linear to the amount of time that you go out. What I mean by that is that if I sell a 1 month call and I collect, let's say, $1 for it, if I sell a 3 month call on that same stock with the same strike price, I'm not going to receive 3 times the premium. I'm actually going to typically only collect about 2 times that premium, which is again why whenever you're selecting between 2 expiration dates, you want to focus more so on the shorter end of the spectrum rather than the longer end if you're comparing 2 different expirations that you're trying to choose between. So with that, just taking a look at strike selection, we generally take a look at strikes based on the distance from the current price. The further away from the current price, the less income you're going to receive. The closer the strike price that you use, the more income you're going to receive. And we typically use delta or probability to select our strike prices. So if you're very conservative and you don't want to have a lot of risk, you want to sell a strike price that's further away from the current price, you usually want to select roughly about a 10 delta call or put. That means you have about a 90% chance that this call or put will simply expire worthless. On the aggressive end of the spectrum, this is really for those of you that want to either have the stock sold or own the stock. That's when you want to use roughly about a 30 delta or about a 70% chance that that call or put will expire worthless. And for those of you that are somewhere in between, optimal, we use about a 20 delta, 80% probability of profit. Now, the difference is depending on the strategy that you're trying to deploy, you're going to want different risk tolerances. So based on our research, when you're selling cover calls or short puts, you generally want to avoid earning cycles. But when you're selling cover calls, you want to lean more towards conservative strikes. So about a 15 to 20 delta is a good starting point when you're selling cover calls. However, and the reason for this is because when you sell a cover call, your biggest risk is the stock that you own will decline in value, which means that in order to offset that, you need to give your stock plenty of upside to appreciate, because that's the reason you own that stock. You own that stock because you think it's going to appreciate in value. You don't want to sell a cover call that's too close to the current price that will effectively cap any potential rewards you have on the stock. So when you're selling cover calls, you want to sell calls that are relatively far away from the current price. When you're selling puts, it's the exact opposite. You want to sell more aggressive strikes because you want a higher probability of owning that stock. When I place a limit order to buy a stock, it's usually placed fairly close to the current price because I want to own that stock, but I simply just want to own it at a lower price. So when you're selling puts, you want to select more aggressive strikes. So about a 30 to 40 delta is a good starting point, again, because you want a higher probability of exercise. And lastly, when you're selling credit spreads, you always want to start by selling an at-the-money strike, about a 50 delta call or put, and to cap your risk, you want to buy an out-of-the-money strike, about a 25 delta. And when you use these types of strikes, you're going to find that the premium you receive on a credit spread is roughly 1/3 the width. So, and the width refers to the distance between those two strikes. So if we're going to sell a 100 strike call, we're going to buy a 90 strike put against that. Or I'm sorry, if we sell a 100 strike put and we buy back a 90 strike put, the distance between those two strikes is $10 because the difference between 100 and 90 is $10. When we select these types of strikes, we want to collect roughly about $3.33, 1/3 the distance between those two strikes. So that's another rule of thumb that you can use when you're selling credit spreads to determine, am I getting enough income on that credit spread? So with that, I just want to talk a little bit about exit strategies or managing these positions before we jump over to options play and show you some examples. Number one, you want to roll your positions if you need to roll your positions with any of these strategies, you generally want to do it within the last week, meaning you don't want to roll your positions too early. The only time that it makes sense to take profit early or roll one of these positions early is if you've gained more than 50% of the income that you can possibly gain, but you still have more than 2 weeks left in that trade. So if you sell a 4-week cover call and 2 weeks into it, you've already made 60, 70% of that gain, that's the only time it makes sense to roll or take profit early. Any other time, if the stock moves against you, you generally don't want to roll that position early, because what that means is that you're locking in a loss and you're not taking advantage of the time decay. So you always want to make sure that you take advantage of that time decay wait until that last week, and then roll your positions within that last week. So if you're selling cover calls, one tidbit of information that I can tell you, and this is not, please don't misconstrue this as tax advice, but if the stock that you sell if you sell a cover call and the stock gets called away on Friday afternoon, if you're concerned about a tax bill, one of the things that you can do is you can actually buy new stock on Monday, provided that you have the cash to buy 100 shares or however number of shares that you need to deliver. And from a tax basis, you can deliver those the tax lot that you bought on Monday for tax purposes, and you don't have to deliver the low cost basis stock to avoid your large tax bills. So if you're concerned about having your stock called away because of tax reasons, that is one way to avoid that. That again is provided that you have enough cash on Monday to buy brand new stock to deliver it from a tax perspective. When you're shorting puts, you always want to make sure you maintain enough cash to purchase the shares. But again, this is really only a strategy if you want to own that stock. You should not sell puts if you do not want to own that stock. So keep that in mind. Because you're selling puts to own that stock, make sure you have enough cash to cover that stock position, either fully in cash or at least in margin if you're trading in a margin account. And lastly, selling credit spreads. One of the concerns that some people have when selling credit spreads is that you can get a sign on that short leg. So what you end up having is you're either long or short the stock, and you have this long call or long put attached to it. And when this happens, keep in mind that just because you got a sign does not change the risk of the trade. You're just simply replacing that short leg with either long stock or short stock, but the overall risk of your credit spread remains the same. And when that happens, if you sell a credit spread and one of the short legs gets assigned, simply close out both legs if they are assigned, and you can effectively have the same amount of risk. So don't be concerned sometimes if you sell a credit spread and you end up owning that stock or shorting that stock as a result of it. So that is a bit of an overview of these 3 strategies, what to typically look for when you're selling these types of strategies, how to manage these positions. And with that, what I want to do is lastly talk a little bit about options liquidity and placing orders, because that is a very large factor of your decision process, because many times you go through the process of looking for cover calls, looking for cash secured puts, or even credit spreads, and then you look at the liquidity or you look at the bid-ask spreads, and you might be concerned as to whether or not this is an order that you should place. And this is a market structure issue that we've seen in the markets over the last 5-6 years, where once you go outside of the top 100 names in terms of market cap, we really see that the options liquidity seemingly drops off of the cliff. And what I mean by that, and many of you have sent me emails asking these types of questions, is would you trade something that has relatively low open interest or volume? You've noticed that bid-ask spreads are relatively wide. If any of you have seen these types of conditions, please type yes into the chat window, because I'm sure many of you have gone through the process of searching for cover calls or cash secured puts or any of these types of strategies, and then realize that, hey, open interest is pretty low or bid-ask spreads are really wide, and you're not sure whether or not you should place these trades. And the one thing that I want to point out is that liquidity on the screens have gotten worse over the last few years. Even though liquidity of the options themselves and the liquidity of the market has not gotten worse, on the screens it looks far worse than it is. So I will want to say that liquidity on the option is really just a factor of liquidity of the stock. So if you think of the stock as liquid, don't be too concerned that the option open interest or spreads are relatively wide, because options may not look liquid, but chances are there's plenty of liquidity. And I'll show you today how I can see that, because the best thing to look at is not the bid-ask spread necessarily, but you want to look at where things are executed. So you'll see that many times I'll see options that are trading where the spread between the bid and ask price might be 50 cents or even $1 wide. But you'll notice that most orders are filled within 5 to 10 cents around the midpoint. So it doesn't matter whether someone displays a quote that's 50 cents wide. If you can get filled 5 cents above the mid price, that's really what you're concerned about. And that's really what you should be looking at when you're concerned about liquidity or execution. So again, don't be afraid to place orders inside the bid-ask spread near the midpoint. Usually when you start 5 cents or 10 cents away from the midpoint, when you have very wide spreads, and you'll see many times you'll get filled. And I want to show you guys how to search for that. So with that, what I want to do is I want to first jump over to options play. I want to show you guys very quickly right off the bat, at least quickly how to look at cover calls and cash secured puts. And then we'll take a quick look at credit spreads, and then we'll jump over to taking a look at some executions to show you how to get a better gauge for options liquidity. So for those of you that are brand new to options play, this is the platform that you'll see. We have trade ideas and watch list here on the left-hand side. In the middle is our security analysis panel, and on the right-hand side is trading and income. And these three panels represent the what, the why, and the how of options trading. Now, today, what we're going to focus our attention on is the income panel. This really allows us to show you how quickly we can search for cover call and cash secured put opportunities, because the goal here is to really show you how sometimes difficult it might be to look for opportunities to generate income. And I want to show you how we use that here at Options Play to really make that process as easy as possible for you. So let me just pull up an options chain here real quick. I want to show you a bit of a comparison here. So here's an option chain. As you can see, many of you that have traded options are familiar with this types of pages where you have lots of different expiration dates, lots of different strike prices, and you basically have to choose from this menu like a phone book to figure out, okay, if I want to sell covered calls and Qs, okay, I have to remember that I should sell weekly options. So which weekly option should I choose? Maybe I'll go out to June. That's about 4 weeks out or so. But then I have to remember what strike prices should I choose. You might remember from one of my webinars that when you're selling covered calls, you want to use more conservative strikes, about 15 to 20 delta. Then you have to search through the chains for that 15 to 20 delta. Then you might learn that you have to figure out the yields on that amount to see if there's enough income. So there's a lot of work, a lot of manual work. And when you do this type of manual work, that's when you're more prone to error, or sometimes just your emotions, because when we're looking at a page filled with options like this, we tend to gravitate towards bigger numbers, especially when we're generating income. We want to generate more income for our own portfolios. Yet many times when we do that, when we let our emotions take over our trade ideas, that's when we deviate from the right strategies. And that's really why Options Play was designed to provide you with guidance based on your personal preferences. So on the income panel, we have time frames so that you can choose what type of time frame you typically want to sell your options with. So mine will always be short time frame for cover calls as well as for puts. But for calls, I like to choose optimal risk tolerance. And for puts, I like to get more aggressive, because when I sell puts, I want to own that stock. So I want to increase my probability of doing that. So you can put in your own settings. And what this does is it searches the option chain for the correct options starting points for both cover calls and cash secured puts. Again, these two strategies represent almost 70% of income strategies for most retail traders is selling cover calls and cash secured puts. Like I said, I utilize cash secured puts as an income strategy to get into my trades. So if Apple's trading at 178, I want to own the stock at a lower price. This is telling me to sell a June 21st 172.5 call. And as you can see, that receives $300 in income. And this means that I have to put aside roughly $17,000, because to buy 100 shares of Apple costs $17,250. But I'm getting a $295 discount on top of that, which comes out to be a 1.65% discount if I'm able to purchase these shares at 16,955 instead of 17,250. So that is the discount factor that I'm going to receive on my stock if I purchase the stock, if the stock goes below 172.5. So if I place a limit order at 172.5, I'm going to have to shell out 17,250 to buy these shares. By selling this put, I only have to shell out 16,955. So that is the 1.65% discount factor that I'm going to receive when I'm selling a cash secured put. And this is really how I utilize options to effectively generate yield on the cash that I'm putting aside to buy the shares that I want to purchase. And then once I've purchased those stocks, that's when I want to sell covered calls on top of that. So this is where I would sell a June 21st 190 covered call. And this generates an annualized yield of 9.12% on a stock that only pays a 1.7% yield. So many of these stocks, especially these tech stocks, they either pay relatively low yields or they pay zero yields, like Facebook. If you own Facebook, you get zero dividends for this. So one of the ways to maximize your yield on a stock that doesn't pay dividends is by selling covered calls. So many of you own Facebook stock in your account today, and how would you like to generate $126 over the next 22 days? That is 69 basis points of the underlying in the next 22 days, which annualizes out to about 11% on a stock that pays you zero yield. These are the types of numbers that you can look at when you're selling short-dated options, weekly options, relatively far away. This is a 192.5. That's about a $10 move in 22 days. From a probability perspective, there's a 79% chance that the stock will be below 192.5, and you're able to collect your 126. And if the stock does rally strongly to 192.5, you've effectively taken profit after the stock has rallied significantly. So this is really the goal of utilizing cash secured puts and covered calls. An options play is designed to automate this process so that for any stock that you type in, we instantly provide you with the starting point for both the cash secured put and the covered call, whether you want to start owning that stock or you already own that stock, and make this as easy as possible so that you don't have to constantly go through pages and pages of option chains to try to figure out roughly where you want to start and then do a lot of manual math to figure out, am I getting enough yield on that? This tool is designed to make that process as simple as possible so that you can type in any stock and immediately get a sense for what your starting point is for selling covered calls and selling cash secured puts, giving you all the metrics and being able to click on a trade button and seeing the current bid-ask price, the strategy checklist, and be able to enter this trade into your broker's platform. So this is really designed to make your life as easy as possible. And for those of you that like to make adjustments on some of these, so for example, if let's say on Johnson & Johnson, because it just made a huge move to the downside, maybe I want to be a little bit more conservative, but I do want to purchase this stock. I can modify this and maybe move this down a couple of strikes, maybe down to the 127, or maybe because it just had such a large drop, you want to get more aggressive. You want to sell maybe a 132. You want to buy this at the current price. You can move these modifications very easily just by the click of a mouse or using any of our drop-down menus, and immediately see that, well, if I place that limit order or sell that put at 132, I'm going to collect $230. That represents a 1.74% discount on the stock. Because if I place a limit order at 132, then I have to put up $13,200 to buy the stock. By selling this 132 put, now I only have to put up $12,970, a $230 discount, which is significant to buy the stock at the current price. And these are the types of returns that you can expect, or the discount factors that you can expect by selling a cash secured put. And once you're in that stock, adding an income yield on top of that, this stock does pay a nice 3% dividend, but you can generate an additional 8.2% on top of that by selling covered calls. And lastly, on the trading side, if let's say, actually Johnson & Johnson, in my opinion, is an interesting example because when stocks are severely oversold like it is today on I'm guessing, some healthcare news, when it drops these significant amounts, or this move actually happened yesterday and things start to stabilize, this is actually a good time to sell cash secured puts. So this is really where you can sell a short call, a short put vertical Like I said, we usually typically sell relatively short dated options, so maybe 29 days out. But we always sell an at the money strike around a 132, and we buy about a 25 delta call, which a put, which brings us roughly about a third of the distance between the two strikes. So 126, 132, that's $6. And as you can see, the current midpoint brings in $1.70, which is about 30 cents shy of the $2 that we're looking for. So this allows me to maybe adjust these a little bit. So here's a $5 strike, and I'm going to collect $1.55. That's pretty close to the third that I'm looking for. That is a quick way to kind of hack a credit spread. Just look at the distance between the two strikes. Always start with at the money, and you want to collect roughly about a third of the distance between the two strikes. So a third of the distance of $5 is $1.67. Here I'm getting $1.55. It's a little bit off, but I'm pretty close. So these are pretty close to the strikes that I'd be looking for on a credit spread. Like I said, if you want to learn more about credit spreads, I have a whole separate webinar just on that alone. I highly recommend you to take a look at this. But our tool allows you to create multiple credit spreads. So if you want to compare one credit spread, maybe one different expiration against another one, you can do this very quickly by selling maybe a 132 versus a 128. As opposed to 127, 132, you can compare different expiration dates, you can compare different strike prices, and then use a P&L simulator to simulate how these strategies will compare next to each other based on different outlooks that you have on the stock, and see how each one of these strategies compare to perhaps another strategy such as the debit spread. This is really the power of options play. It really allows you to set up any three strategies side by side and compare them based on your outlook on the underlying stock. So if you expect Johnson & Johnson to recover back to, let's say, 136, how these strategies perform, or if you expect that to maybe stay exactly where it is, how each credit spread will actually perform as well. So with that, that just gives you a quick demonstration of how options play is designed to quickly allow you to find cover calls, cash secured puts, and credit spreads. And now what I want to do is I want to spend just a couple of minutes addressing this concern that many people have about options liquidity. So I have a few examples here. I want to look at names like Northrop Grumman, big defense stock, very liquid stock from a stock trading perspective. However, if you look at the options, they are pretty, sometimes pretty wide. So if you see, this is the July weekly options. Here's the July monthly options. As you can see, you have a lot of spreads that are, 40, 30, 50 cents, 30 cents wide. So a lot of times, and if you can see, the open interest on many of these strikes are pretty low, even though this is a stock that has plenty of liquidity. And if you can see, this July weekly option has zero open interest. And I get a lot of questions from users saying, if something has zero open interest, should I trade it? And the answer is zero open interest should not be a reason to not trade something, because open interest just reflects what people like to trade. And people tend to like to trade monthly options, and people tend to likely trade round numbers. People don't, it's just a psychological thing. It has nothing to do with liquidity. What's far more important, what you should be looking at, is where things are actually executed. So if we look at some of the executions on this particular name, and I sorted this by quantity, just so you can get a sense for even the large trades. Here's a large May 30 280 put, a 280 call that at the time was trading at 28 bucks by $30.80. So that's a spread of $2.80. That's a pretty wide spread. Notice where it actually gets executed. It pretty much gets executed at the mid price right here. It actually gets filled 10 cents off of that mid price. Even though the spread was $2.80, it got filled 10 cents off the mid price. So it doesn't matter that the width of this, the bid ask spread was $2.80. Look at where things actually trade. Here's another example, 35 contracts. It was trading at 110 by 130, which means the midpoint's 120. The execution was at 125, 5 cents off the mid. Here's a 190 by 210, 20 cent spread. It gets traded at $2.01, 1 penny off of the mid price. So it doesn't matter how wide someone quotes it. It really matters where something can get executed. And many times, as you can see, most executions are within 5 to 10 cents of the midpoint, even if the spreads are showing 10, 20, 30 cents, 50 cents wide. It doesn't matter how wide it's quoted, and the fact that there was zero open interest All you have to look at is how something gets traded. And there are so many examples of this. And I'm only looking at S&P 500 stocks. These are stocks that are easy to borrow, very easy to short, yet they have very wide spreads. So BIIB, Biogen, a lot of these biotech stocks or healthcare stocks, we see this type of pattern where an at-the-money call gets traded at, this weekly option has a spread of over of $1.90 on a at-the-money call. That has zero open interest. So many people will come to me and say, hey, I'm not going to trade this because spreads are really wide and open interest is really wide. But if we look at executions, let's take a look at some of these executions. As you can see here, here's 200 contracts. It was trading at 310 by 330, so a 20-cent spread, and the midpoint's 320. Notice how 200 contracts got traded at the midpoint. Don't be afraid to interact with that midpoint or just a few pennies off of that midpoint, even if things look really wide. 420 by 440, midpoint's at 430, it got filled at 430. Same thing here. Notice how all of these executions, these large executions get filled at the midpoint. So when you're trying to fill 10, 20, 30 lots, don't be afraid to interact with the quote. Look at how many of these get filled either at the midpoint or just a few cents off of that midpoint. So regardless of the fact that you see very little open interest, the fact that there's no volume and spreads are really wide is not an indication that you can't interact with that quote. And even on stocks like IBM, which is probably one of the largest stocks in the world, notice how on the weekly options, you just have less open interest. And does that mean the weekly options are less liquid? Absolutely not. Because the liquidity of an option is a factor of liquidity of the stock. From a market maker's perspective, it doesn't make a difference to him whether he's making a July 12th option or a July 19th option. From his perspective, it's all the same. And if we look at executions, we can reflect that. So, many times, here's 197 contracts that got traded at the midpoint. Granted, this was trading at just 2 cents by 4 cents, but as you can see, large executions get filled pretty much at the midpoint or just a few pennies off of that midpoint. So even like names like IBM, we see some pretty wide spreads sometimes. Don't be afraid of interacting in between the quote. Even something that's pretty tight here, 254 by 259, that's a 5-cent spread. Midpoint there is 257 and it trades at 256, basically half a cent off the midpoint. So again, I hope that this illustrates to you that regardless of what you see on the screens, the fact that there's zero open interest or zero or very wide spreads, that's not an indication that you can't trade this. And I have plenty more to show you. I'll just do one more because I think I'm showing you this point here. So here's waste management, also an easy borrow stock, S&P 500 stock. But we see pretty wide spreads on some of this stuff. If you look at July, 5 cents by 25 cents. A lot of times you might be selling a cover call and you might see 0 by 15 cents. And you're not sure how to place these. So here goes on 207 contracts traded at pretty much the midpoint, 155, 170. Midpoint's at 162. It gets filled at 160. So 2 cents off that midpoint. So no matter the fact, so don't be afraid when you see these large spreads to try to interact with the midpoint. Many times, even if you see a spread that's $1 wide, place an order that's 5 cents away from the mid, 10 cents away from the mid. If you don't get filled, then okay, that's okay. It's okay, you don't get filled, but don't be afraid to try to interact with the quote because you will see many of the time you get filled very close to that midpoint. So with that, I've gone a few minutes over my time slot. So at this point, what I want to do is I want to thank everyone for taking the time out here this afternoon. I hope that this was useful in helping you guys see the power of how options can really be utilized in all different scenarios, regardless of whether you're thinking about buying the stock or you already own some stock or you want to speculate on some stock to generate income using options. So with that, what I want to do is I want to open this up for Q&A. If you have some questions, please please type them into the chat window. I'll answer as many questions as I have time for here today. I hope that that last piece on options volume and liquidity was interesting for some of those of you that are interested in interacting with the quote, but sometimes might be concerned about liquidity. So please type them into the chat window. I'm happy to answer as many questions as I have time for here today. Serge is saying, why credit calls are basically never suggested by options play? So credit spreads, credit call spreads, that's a good question, Serge. I'm happy to answer that question, but I feel like that's getting a little off topic from what we're talking about here today. It really has to do with the fact that, statistically speaking, markets move higher. The probability of markets moving higher versus lower is always skewed for markets moving higher. So call credit spreads always have a statistically a lower chance of being profitable than put credit spreads. So that's the simple reason. If you want to learn more, please send me an email at info@optionsplay.com. I'm happy to answer that. Francois saying above current price or above purchasing price. I think you're asking about cover calls, and the answer is above current price. You always want to sell a cover call above the current price. Just a small question. Sell short puts. Does this mean short put or short put position? This means sell short puts. What that means is entering a sell to open put position, if that makes sense. So it means to short a put. I'm not sure how to answer that question. Selling short puts is just referring to shorting a put. I hope that answers your question. Gregory saying, how do you rescue bad spreads? Seems like you've hit on 8 big ones and had two big losing ones. That's a good question, Greg. The really only time that it makes sense to rescue a bad spread is if you would enter that same rescue trade as if you weren't already in a losing trade. Unfortunately, we've had a bit of a pullback in the markets that got a little overextended. That certainly gave back some of our gains. But I will say that we certainly were a bit ahead of the game than when we did have those 8 winning trades in a row. So we do try to do our best on staying on top of all of these positions. But that at the end of the day, that is the nature of trading. When markets correct, sometimes that your long positions will give back some of your gains. Francois is asking, on cover calls, you know that your stock will be called away. Do you roll to keep them or do you let them go? That's up to you as to whether or not you continue to believe that stock will keep moving higher. If you believe that stock will keep moving higher and you want to take advantage of that, you want to roll that cover call. If you're happy taking profits at these current levels, or you think that the stock is near its top, that's when you want to let the stock go. Thanks for another great session. This is PD here, a subscriber to Options Play. One question regarding the offer on credit spreads about stock twits. Could I get a new promo code, please? PD, why don't you send me an email at info@optionsplay.com and I'll take a look into that for you. Boris, see you in Montreal. For those of you that are in Canada, I will be at the Options Education Day in Montreal this Saturday. So I will be doing 2 sessions there. I hope to see those of you that are in Canada there. And for anyone that's here on this webinar today, you will get the recording. So that's your answer, Boris. Alice saying, which accounts can selling short puts be used? So that depends on your brokerage firm, Al. You would have to call your brokerage firm, get permission to sell puts, and they would be able to tell you what type of accounts you can do that on. Bradley saying, on an American style option, if we get assigned, is there still a buffer to be able to close out the option position? No, once you get assigned, it's done. There's nothing you can do. Also, how are the sale of calls and puts taxed? Bradley, I am not a tax. I shouldn't comment on tax because of the implications on that. However, it really depends on whether you're in a taxable account or non-taxable account, and I'm not even sure what jurisdiction you're in. So I'm going to hold off on answering that question. It's best to call your tax professional to help you with that. Bradley saying, if a top 100 stock has options showing 0 open interest, how short are we that at least a market maker will take our trade, at least at the bid ask? Well, a market maker has to take it at the bid ask. That's the requirement of posting a bid ask quote. At the very worst, you'll get filled at the bid ask. But what I'm trying to say is that 99% of the time, you will find yourself trading much, much closer to the mid price, especially when the bid-ask spreads are really wide. Paul is saying, how does the program show you percentage in and out of the money for puts and call rights? So Paul, no, I guess it's not difficult for you to just calculate it on your own, and maybe we can add that for you. But from our perspective, you shouldn't think about distance from a stock on a percentage standpoint. And the reason I say this is because percentage standpoints don't mean a lot because things shift all the time, right? Because if Johnson & Johnson has earnings tomorrow, then 5% out of the money means very different than if earnings are coming up 6 months from now, or I'm sorry, 2 months from now. So that's why percentage out of the money doesn't account for the fact that volatility increases and decreases. However, delta does. And that's why we always use probability to determine a distance from the current strike. So here, the 137s have a 78% chance of expiring worthless. Now, because Johnson & Johnson doesn't report earnings for another 47 days, that's a relatively closer price, so $5 out of the money. Gives you that 80% probability of profit. But if Johnson & Johnson is reporting earnings tomorrow, then that same 78% probability strike will probably be a 138 or 139 or even 140 because earnings is about to come up. So that's why we don't like to use percentage, because percentage doesn't account for the fact that there are certain times when volatility is high and 5% means a different thing than when volatility is low. So that's why we always use percentage probability to determine percentage out of the money. I hope that makes sense to you, Paul. And especially if you're concerned about getting consistent income, you want to use probability as your anchor, not percentage. Because you use percentage, it'll work fine when there's no earnings, but when earnings is coming up, that same 5% out of the money may not be enough. So unless you can adjust for that accordingly, probability automatically adjusts for that. So that's why we always use probability to select our strikes. Jacob's saying, when referring to where orders are executed, oftentimes near midpoint of bid-ask spread, are you encouraging limit orders at midpoint when high probability is getting filled, or are some of those market orders that are getting filled better than quoted price? So Jacob, very, very good question. Now, depending on your broker, now if you trade with any of the major brokers like Fidelity, Schwab, TD Ameritrade, you should be able to place your order and you should be able to place a market order on most liquid stocks and get filled very close to the midpoint. But my suggestion for most users is, you can try market orders, but I certainly don't encourage someone who's new to options trading to place market orders, even though I place a lot of market orders myself and some of my best executions come from market orders. But what I was saying is placing a limit order a few cents above or below the midpoint, depending on whether you're buying or selling, and seeing how you get filled. Because on something like 30, let's go for something a little higher dollar amount. Let's look at these Octobers. As you can see, this is $3 by 360, right? So the midpoint's 345. I would probably place, if I was buying that, a limit order at 350, 5 cents above that midpoint, even though that's 10 cents below the asking price. You will see that many times you will get filled at that 350 level. So I'm suggesting that you place a limit order, but if you are trading with one of the major brokers and you want to test out a market order, you'll see that market orders many, many times gets actually better fills than limit orders. Can we get the recorded video? Everyone that's already on this webinar or is registered for this webinar will receive the recording 30 minutes later. Wari, I'm impressed with this webinar. My first, please, where can I view other webinars? Great question. So for those of you that are new to options play, you can take a look at our YouTube channel, which we have a playlist with our latest recordings. So I highly recommend you to take a look at that. I just sent the link for that in the chat window. Joseph, how do you recover from a put credit spread that has rallied down past the short and long strikes of the spread? In my opinion, there isn't a way to necessarily recover from it. The best way to do that is simply get out of the trade and cut your losses. Because what you've effectively done is when you put on a credit spread, you're basically saying, I don't think the stock's going to drop. And when the stock drops, that means you're wrong. Be okay with admitting that you're wrong and move on, because throwing more money at it just means that you can potentially lose more money at it. And just to try to get back to break even, That's what I don't like to do, because that is really when you find yourself in a hole where you put good money after bad money. The only time where it makes sense to try to recover from that is ask yourself, if I wasn't already in a losing trade, would I sell another put credit spread? If the answer to that is yes, then I would say, okay, sell another put credit spread, try to recover your money. But when you ask yourself that question, I tend to find 9 out of 10 times, the answer is always no. I would not trade another put credit spread if I wasn't already in a losing trade. And because of that, that's usually why I would not enter another put credit spread to try to recover my losses. Was this webinar recorded? Yes, webinar is all recorded. Kelly is saying, any in Toronto? Yes, the next Options Education Day in Toronto, I believe, is September. So you can check the Montreal Exchange's website. They will have the listing there, Kelly. On a cover call, what does roll to keep them mean? So roll just simply means, okay, great question. So let's say I sell this June 21st, 137 cover call on Johnson & Johnson. Let's say I own 100 shares of Johnson & Johnson. I sell this 137 call. And let's say on June 21st in the morning, the stock's trading at 140. If I don't do anything, I will lose the stock at 137, meaning I will sell the stock at 137. If I don't want to sell the stock at 137 and I think the stock's going to keep going, right? Then the stock rallies back up to 140. Maybe I think the stock's going to keep making moves back up to 150, 160. Then what I want to do is I want to roll that cover call. So what that means is that I want to buy back like June 21st, 137 call, and I want to sell another cover call. So I would come back to options play. At that point, it might tell me to sell the July 145s. I would then buy back the June 137 calls. I'd sell the July 145s, and that whole order of buying back the existing call and selling the new one, that is what we call rolling the cover call. So that's what we do to keep the stock, because what we're effectively doing is we're saying we don't want to sell the stock at 137, we're going to roll our cover call further out and higher up. Bradley, thank you so much. I really appreciate it. I'll see you in Montreal. Jeanette is saying, I like very much your presentation. Thanks. See you Saturday on the options day. Thank you so much, Jeanette. I'll see you there. Adina is saying, insofar as buying new stock on Monday following the assignment of a call option on the existing stock the previous Friday and wanting to avoid a large tax gain liability, this is an option you mentioned today. Is this applicable to U.S. investors and Canadian investors, or only to U.S. investors? So that is only for U.S. investors. I'm not saying that you can't do that in Canada. I just don't know the rules in Canada, or whether or not Canadian tax laws need to be first in and first out, because in the US, it's not first in and first out. So you can deliver any tax law from a tax purpose. So I guess the question for your tax professional is, when you sell a stock, is it first in, first out from a tax perspective? If it's not, then likely you should be able to do it in Canada as well. Francois is saying, how do you make delta appear in options play? You can click on the blue arrow of any strategy, and there's a button at the bottom that says explain strategy in Greek. So you can see the delta there. Delta, theta, gamma, vega, all of that is there. When I click on details and look at the Greeks, I see dollar amounts. Shouldn't be percentages. So it's all the same. So 79 is the same as 79%. We put them in dollar terms because that's what you really want to see in terms of Greeks, right? The reason that we look at Greeks is because we want to calculate what is the dollar impact to our stock, because delta tells me if the stock goes up by $1, how much do I make? And that's what 79.30 means, which is the delta, which is 79.3%. Theta is 0.372. So why do we look at 0.372? Because we want to know that for every day that goes by, we lose $3.72. So the dollar sign and the percentage signs are completely interchangeable. Alan, thank you so much. I really appreciate it. Raymond, thank you so much as well. Are there any more questions? Serge, I will see you on Saturday. Laura, there are 45 trade IDs in options play today. How does one view those that start with G? Only part of the alphabet is available. You can sort it by the company name, and you can see G's here if that's what you're looking for. I hope that answers your question. Any other questions before we sign off for today? There are no other questions. Again, I just want to thank everyone for taking the time out here this afternoon. It looks like one last question. Joseph is saying, what point do you adjust a put credit spread heading south? Great question, Joseph. I covered this specifically in our credit spread webinar. The answer is that it depends. If you're following the same rules that we are for selling a 50 delta and buying back a 25 delta, which is the ratio that we see works the best with selling cover with credit spreads, and you're receiving roughly a third of the width, the rule of thumb is to simply cut your losses when you have about a 50 to 75% loss on the income piece. So if you're collecting $1 and now you're down 50 cents to 75 cents, that's when it's time to start cutting losses and moving on. If you're collecting less than 1/3 of the width, that's when you want to adjust that a little higher, about 100 to 200% of the income that you receive. So credit spreads is a little tricky because it depends on the amount of income that you receive, because that will determine when it might make sense to cut your losses. So if you want to learn more, I highly recommend you to take a look at the YouTube channel, which we do have the credit spread trades there. So again, I'll put this link in the chat window. You can go to our playlist and you can see we have a video here called Maximizing Income with Credit Spreads. I would highly recommend you to watch that video if you want to learn more about managing credit spreads. Again, thank you everyone for taking the time out here this afternoon. I hope you guys have found this useful. I will see you guys next Thursday. Have a great evening.